Hey there, everyone. Happy Friday. Welcome to Chart This with Dave Keller. It's Friday, March 7th, 2025, and I so appreciate you joining me here. Now from a sunny Baltimore, Maryland. We have migrated from New York, where we spent most of last week, down to Baltimore. I'm actually in town for board meetings for the Walden School, which is a fantastic nonprofit organization trying to make everyone's lives a little better through music. They run a summer music camp for young musicians, school-age musicians, also a week-long music retreat for adults. You can find more information at waldenschool.org. And if you have any musician, especially composer, tinkerer kind of music friends in your lives, I hope you point them to the Walden School. It's a fantastic organization of some really wonderful musicians that I'm so thankful to be associated with. And also excited to get back home to Seattle on Sunday. It's been a long week away from the family. Hope you guys are all doing well. We're going to do a brief market recap here to kick off today's show, and then we'll focus the rest of our time and attention on the mailbag. As I remind you every episode, we love to take questions during the live broadcast at the end of the live stream. A lot of questions we don't have time for day to day. And so on Friday, it's great to take a step back and just a little more thoughtfully and deliberately go through some of the great questions we received through the course of this week. I grabbed some really interesting ones that we received here in the last couple of days to share with you. All right. Before we go any further, or I guess to go further, let's get to the market recap, talk about how things played out. We're recording this a little bit early, about 3:15 Eastern time, just because of the timing of events this evening for me. But as of now, having a nice bounce right earlier on Friday, sort of sold off out of the open. But But then going through the course of the trading day today, after lunch, we're kind of having a nice rally phase. For now, the S&P currently sitting about 0.6% higher. That's to around 5770 and change, a little bit above there. For me, the 200-day moving average is vital. We're trading all around it today. The Nasdaq 100 already breaking below its 200-day moving average. Does the S&P get a valid close below, which I think would set us up for potentially more weaker price action going into next week. 200 days key. Also, our market trend model looks highly likely save some huge rally going into the close, which is possible. I would not put it past this market to just completely change things going into the weekend. But for now, it looks like our medium-term market trend model will indeed turn bearish for the first time since fourth quarter of 2023. It's been a while here, and all through 2024, our medium-term trend model remained bullish. Keep that in mind, because one of the questions asked about portfolio allocations. I'll tell you how I use that market trend model to think about my own allocations. Having said that, large caps, mid caps, small caps, all in the green for now. The VIX drifting slightly lower, about 1.2 VIX points down, still in the mid 20s. And again, barring some huge change, it looks like volatility certainly elevated. Now, the whole volatility picture over the last 6 months has changed pretty significantly. And I would say we are certainly changing into a higher volatility regime with the low volatility environment from like mid 23 to mid 24. Certainly looks like that's behind us. And we're now in a higher volatility environment. So buckle up. Looks to be a continued bumpy ride through the course of 2025. For now, the dollar slightly weaker, bond prices slightly weaker as well. So you have stocks going higher, bonds going lower. And interest rates generally moving higher. Gold and silver, not too much of a down day. Energy, though, the big, I would say, upside surprise today with crude oil prices moving up. Also, natural gas prices moving up as well. Energy, for now, the strongest sector. The cryptocurrencies continue to give back some of their previous gains, although kind of mixed right now when you look at the top 10 coins tracked on the stock charts platform. I point out Bitcoin currently around 88,000, so we're continuing to sort of have some failed attempts to get above that 90,000 level. Big 10,000 increments have been pretty meaningful for Bitcoin. So I think pushing above 90,000 would be a pretty important threshold to get above, and we're not quite able to do that yet. Again, market not closed yet, but for now, going into the last 45 minutes of trading, it looks like energy and utilities at the top of the list. Energy up almost 2% today for now. Technology also about 1.1% higher. So some of the growth sectors, some that is moving slightly higher today. For now, financials and consumer discretionary are the only two in the red. And financials, again, having kind of a rough week. And financials have been one of the better sectors on a relative basis year to date. But this week, not really feeling it, and about 0.5% lower for the XLF. As I mentioned, our market trend model looks highly likely, again, barring some huge rally going into the close. Oh, man, I keep doing that. Sorry. Looks like our market trend model will indeed turn bearish on the medium-term time frame. For me, that's actually pretty meaningful. While the S&P is holding its 200-day moving average for now, that medium-term trend model for me is a big way that I determine risk in the portfolio. Medium-term model bullish means risk on, generally speaking, focus more on capital growth than capital preservation. Medium-term model bearish, that tells me to do the opposite, go more risk off, focus more on capital preservation than capital growth. I just want to try to ride out a period of market instability, try to raise cash. So, at some point when we have some tradable low and then the medium-term model turns back bullish, the only way you can buy into that next upswing is if you've taken profits on the way down as we rotate lower. And that's kind of where my mind is going into to this weekend. Breadth on Friday, pretty decent again, going into the last 40 so minutes of trading. The S&P in particular, almost a 3-to-1 ratio of stocks up versus down. So, jobs number earlier today was a little lower than expected when I looked at the results earlier today. But for now, kind of a nice relief rally, I would say, going into the close. Magnificent 7 names you can see kind of mixed here, going into the final innings of Friday's trading, and Nvidia and Apple both bouncing higher today, which is pretty good. So it's 2 of the technology members of the FANG stocks going higher. Netflix, though, continue to show some weakness. Here's what the market carpet looks like, and again, on a day that's just slightly higher, the big up moves and the big down moves tend to stand out. So a couple things that I'm looking at going into the weekend, number one, some of the resilient moves we're seeing in technology. IBM up 4.5%. Palantir, which has gotten crushed recently, bouncing up about 5%. Now, granted, that's up 5% after being down a ton of percent over the last month, even over the last couple of weeks. So let's be clear, it's still down a ton. Broadcom bouncing higher, 7.6%. So again, stocks like Broadcom and Palantir bouncing higher. That's not a bad thing. I don't think that's bad. But again, if you look just this week, still a really rough week for both of those stocks. So this feels kind of like a counter trend bounce after a period of deterioration. Also noting some of the weakness in the big box retailers. You have Walmart down about 2.8%, Costco, which is an earnings name, down 6.7%. So those 2 names, the 2 biggest weights in the consumer staples sector, not doing particularly well today. Just rapid fire through some of the charts that are top of mind for me. I'm watching very close. I feel like I've had this chart up and I've been refreshing it about once every 2 to 3 minutes, just kind of seeing where we're at relative to the 200-day. We did trade down all the way to about 56.60 today, and just highlighted here. And for now, we're trading back above the 200-day moving average. So appears to hold. Again, we'll see what happens in the last half hour here. But overall, if this is how things end up, pretty good finish for the day and for the week. Although the week is still a down week for the S&P and the Nasdaq, holding the 200-day is pretty important. So I think that would be pretty meaningful. I just want to draw here that the S&P down about 8% from intraday high mid-February to intraday low this week. The last major pullback we have is about a 5% pullback. The biggest one we had last year was a 10% pullback in July into the August low. Previous to that, it was the April pullback around 6%. So at about 8%, we're kind of in the midpoint of these kind of buyable dip kind of moves. If this is another one of those buyable dips, you kind of would be looking for a low in this general range, kind of 56 to 5,700. But I think if we violate the 200-day moving average, and again, I would argue most likely that's probably going to happen, given all the deterioration signals we've been covering, I think, very closely on the show. And if that happens, that's where I think we initiate some further downside targets. So think of it like an if-then statement. If we break the 200-day, we're probably going to go a lot lower. Now, the NASDAQ 100 did cleanly violate its 200-day moving average. As of right now, it's literally right at the 200-day. So, again, something to watch going into this weekend to see if these hold. And again, never that surprising to see a bounce off of the 200-day. That actually happens quite often because there are a lot of people that are betting on that to happen. They're betting on a tradable bounce. They're going to take that shot. And then if it doesn't hold, that's when things can start to be liquidated very, very quickly. Another thing I'm watching is the newer Dow theory, which looks at the equal weighted S&P for now holding its January low, equal weighted NASDAQ 100, very close to not holding its January low. And actually earlier today, it was below that threshold. We've had the nice rally here in the afternoon Eastern time. So continue to watch those levels. If they hold going into the weekend, I think next week it's all about whether these equal weighted ETFs hold their January low. Because if they don't, if they both break below that Jan low, that would be a confirmed bearish signal from Dow theory. We've not had one of those in quite some time. Stocks like CrowdStrike right at the 200-day. I'll refresh the chart here because we might have bounced a little bit. Yeah, we're literally right at the 200-day as we go live here. Again, a pullback off of the previous highs, testing the 200-day. I mean, this is pretty much the level, right? If this holds, then we're okay. If not, that's when we can be concerned about further downside. Costco breaking the 50-day moving average today. This is one of the earnings names today, and it's not been great, right? So, I mean, this is gapped lower today and traded lower. So you didn't gap lower and then have a bunch of buyers coming in, pushing us back into that range. We gapped lower and then traded lower. And we also gapped right below 1,000. So we have a big round number just above today's high. That seems to be most likely a good resistance level. I did get a question on BJ's. I'm not going to talk about it too much, but just to point out that while Walmart and Costco both getting dinged today, BJ's actually breaking out. So, I mean, what do I think of this chart? I think it's making new all-time highs. And in an environment where very few things feel like they're making new all-time highs, I think these kind of charts are showing you that there's strength, right? I mean, in general, these are strong price, strong momentum, strong relative strength. Those are the types of charts I like looking for. So I think BJ's is a pretty compelling chart right about here. All right, let's get to the questions. And again, thanks so much, all of you watching live, dropping questions in as we do the live stream, putting questions in later on our YouTube channel. I gather all of those, try to get to as many as I can through the course of the week, but I appreciate so much doing so. Let's see. Can you comment on the China market? Is it going to continue the uptrend? Well, I can't guarantee anything is going to do anything tomorrow. I'm a trend follower, not a trend dictator, so I can't really tell you what's going to happen. But I can use the best practices of technical analysis to try to break things down. Let's look at FXI. So, I mean, the short answer is China looks very, very good. And China is one of the many non-US markets looking quite compelling here. And again, this is not a geopolitical discussion. This is not a commentary on any sort of government, anything. I'm looking at the charts here. And again, I think we spend way too much time as investors debating why something should be going up or going down, and not enough time just recognizing the reality that things are going up or going down. So we can argue the whole year for the last 12 months as to why China shouldn't go up. As a technical analyst, I will show you the chart and say it's going up and to the right, and those are the kind of things I want to own. Same argument for gold, right? If you told me in 2024, S&P and the NASDAQ are going to be up 20+%, I'd say gold is probably not a great bet in that environment. Ended up outperforming both of those equity benchmarks for most of the year, also outperforming year to date in 2025, by the way. So I think the chart of the FXI, which is what we're looking at here, MCHI and FXI are the two that I tend to focus on, but you're welcome to bring up other benchmarks as well. This is a US traded ETF for large cap Chinese stocks. And so a couple thoughts. Number one, the general trend is positive. We're making higher highs and higher lows. We're above two upward sloping moving averages. My market trend model, which I love to apply to different global ETFs, bullish across the board. So at a time when the U.S. markets, the S&P and the NASDAQ are bearish short term and now bearish medium term as of today's close, most likely, and still bullish long term, charts like China, charts like Germany, a lot of other developed Europe in primary uptrends of bullish trends across the board. So generally, those would be the charts I would be much more interested in than the U.S. market, which is not currently demonstrating that strength. So I think the trend is positive. If there's anything that concerns me, it's if the chart looks a little weird to you, that's because we've had these big spikes higher and then gentle pullbacks. And markets usually trade with gentle rallies and then sharp pullbacks, right? One of my mentors, Ralph Ickenpour, loved to quote, and I forget who is originally credited with this, but the markets, take the escalator up and the elevator down, right? They sort of gently go higher up the stairs, but then quickly sell off when people get nervous and start to sell positions. China has kind of done the opposite. It's had these big spikes higher. It's led to overbought conditions, and when we come out of those overbought conditions, we often have a tradable pullback. We had that in May of last year. We had that in October of last year. Maybe we're having that right now because we were recently overbought and just coming out of that overbought region. So is today the day that I would be adding to a position in FXI? Probably not. Would I be looking for an actionable pullback, maybe to the 50-day as an opportunity to layer in? I probably would be more along that mindset. Great question, though. And again, what's great about technical analysis is it is very easy to analyze global markets on an apples to apples basis, right? To think about China versus developed Europe versus emerging Latin America versus, Canada or US large caps, right? Charts give you a way to combine these and relate these charts in a meaningful way. It is really hard to think about the Chinese market from a fundamental perspective and then also analyze things in Latin America and developed Europe and developed North America. They're just very different markets. If you don't really understand them, it's really hard to get your head around how these companies file and what the growth prospects are and all of that. Charts kind of get that done for you because they allow us to compare lots of different things in lots of different regions on an apples to apples basis. One of the many benefits of charts. Next question. Is it wise to have a portion of your portfolio that never gets touched or traded? You may or may not realize that on this show and with my other content, hopefully never make any sort of recommendations. And I have tons of disclaimers that I will offer at the end of every show. I have a panel that pops up and says, this is not a recommendation. So, and the reason is because our investment goals could be very different. I don't really know your particular, whoever asked this question, I don't know your particular financial situation, what your goals are. That's why, doing your own due diligence, working with a financial professional to understand how to answer those questions is much better than me trying to tell you. And I'm not regulated or licensed to be able to advise you on any sort of investment portfolio. I'm an educator. My goal is to empower you to make better decisions for your own. So the best I can do, I have no interest in telling you how to run your portfolio. I am very happy to share with you the best practices of technical analysis. I'm happy to share with you how I do it, but I'm certainly not telling you it's the right answer for you. So with that, long disclaimer in mind, that is what you're implying in your question is certainly a general way to think about investing, right? There are a lot of different, general schools of thought. The way that I tend to think of it and the way that I run my own portfolios, it's sort of a mix of the core and explore model. I'm trying to think of another way that people have described that. That's the one that I like the most. You have a core position, which is in index funds or in ETFs or big things that you're probably not touching a lot. And maybe you are, and I have adapted a way that I do that. But so there's a core position that probably shouldn't change a ton. And then there's the explore portion, which is a smaller percentage, which you do trade more actively. That's how I tend to think of it. And I'll put a link in the description to the book Tensile Trading by Gaddis and Grayson Rose. I worked with Grayson for years at Stock Charts and still, work very closely with him as a Stock Charts contributor. Grayson's awesome, really good educator and investor of his own right, and learned from a fantastic investor, his father. They wrote this book together where they talk about, just how to structure an investment process and sort of their mindset. And they talk about the core and explore model, right? And having that main position, which you don't touch a ton. Now, that main position, what do you do with it? There are a lot of different philosophies on how you could do that. It could be just an index fund that you never touch. I actually have a momentum model, which rotates my core position through different things. And I allocate to equities, bonds, commodities, all different kinds of equities based on which areas of the market are showing a lot of strength. I'm going to have like a set of book links in the description as I'm offering to do so. I'll include a book also. There's a couple that I like. I like Dual Momentum Investing by Gary Antonacci. He's someone that I met years ago. I love his work, and I'd love to get him on the Market Misbehavior podcast at some point. I'll try to make that happen. There's another one by Wes Gray and Jack Vogel, and I forget the name of it, but I'll include links to those. Those two books really were formative in my own development of my investment process, kind of helped me improve how I was thinking of things. They advocate for momentum-based models of the Ivy League portfolio, if you've seen that, similar kind of idea where you're basically looking and following the strongest areas of the market and just having a natural, regular process where you reallocate based on which areas the markets are showing strength. So I kind of use that for the core position, and then I use the explore portion, which is more active. And these are just things that I think could be interesting: Bitcoin, cannabis stocks, random Berkshire Hathaway, Disney, random things I currently own that are in that explore portion for different reasons on different time frames that I think are kind of interesting. Some are a little longer term, some are shorter term, but the explore portion is where I'm doing things actively. The core portion, all I would suggest is if you have like a core position, make that less. I would say it's better to make it less actively tried. That should be more of a passive thing, more of a core position that you're not messing with too much, because that's where you're benefiting from the long runway that you have. The explore portion is where you take more active bets when you think maybe things are mispriced or you think there's an opportunity. Now, again, that's one philosophy. There are a lot of other philosophies on here. Another idea would be like a 60-40 portfolio, 60% stocks, 40% bonds, maybe 60-30-10, 60% stocks, 30% bonds, 10% alternatives, real estate, commodities, things like that. And maybe with the 60% equities, it's a series of positions. One of the questions later is about an individual policy statement. Maybe that'll help, nudge your thinking on those questions. So those are some of those thoughts on that. And again, I don't know that there's a right answer, and I'm certainly not here to tell you there is. But so those are some of the philosophies, and I would encourage you to read some of the books that I put in the description to learn more about some of those ways of looking at core versus explore and momentum models, because I think that's where a lot of individual investors certainly could improve their portfolio construction. Next question is Amgen showing an inverse head and shoulders pattern. How high do you think it can go in this risk-off environment? I loved your question so much, and that's why I selected it. There's kind of a two-parter, right? Number one, what's up with Amgen? Number two, how high do I think it can go in this risk-off environment? So let's start with the second part of your question, which is how high can something like this go in a risk-off environment? And the answer is it can go really high, right? And the, market history is filled with examples where the major benchmarks are not going up, but stocks like Amgen go up a ton. And I can't guarantee Amgen is going to be higher a month from now. I don't know what's going to happen a month from now, but I do know that the chart is going up while a lot of other charts, arguably most charts, are not going up over the last couple of weeks, right? If you look year to date, Amgen has had a fantastic, consistent uptrend. So, again, the goal of technical analysis is to focus on where we're seeing opportunities and follow those opportunities as long as possible. So, when a stock is in an uptrend, when the momentum is strong, when the relative strength improves, I mean, this is an improving chart getting better. Facing key resistance. So I would say from a technical perspective, the challenge is, can you get above those July, August, September 2024 highs? And I think that's the challenge for Amgen probably in the days and weeks to come. However, I think the trend in the short term here is quite strong. And so with a chart like this, I go into trend following mode. I draw trend lines here. I'd be looking at the relative strength, looking at the momentum, looking for new highs on weaker momentum. That would be called a bearish momentum divergence. You're not getting that yet. Look for a break of trend line support. You're not getting that yet. We're breaking above the 200-day, so failing to hold support. None of those things are happening. I mean, the chart is going up until it's not, and I would say it's still going higher. I would caution you though, because in your question you said, how high do I think it can go in this risk-off environment? Some people out there think, okay, the markets are weak, so I shouldn't buy any stock, right? I should, don't touch Amgen because the markets are going down. I'm a fan of owning things that are going up, regardless of what the market is doing. And that probably comes from spending a lot of years at a big money management institution, really dominated by stock picking mentalities, the Peter Lynch model of, buying what you know and focusing on stories and individual themes and betting on the long-term appreciation of good companies. And so, regardless of what the market's doing, if Amgen's going up, I wouldn't not own Amgen just because I'm worried about the market. I'd own Amgen as long as the price is going up. So the technical analysis approach would be buy strength and own things that are continuing to be in an uptrend. Amgen's doing that. So I don't know if I would think anything differently here. I do want to take a brief moment, by the way. If you like what we do on the show and you want to learn more about the technical analysis tools that we use, if you want the ability to ask questions every day and have me available to answer them, if you want access to my members only reports where we go through a lot of these and talk about more positioning and individual ideas, go to marketmisbehavior.com and click on become a member in the upper right corner. This will give you all the details about our memberships, the pricing, the structure of it, all of that. It is super easy to sign up. You are welcome to check it out. What a lot of people do is start with a month to month and just see how that goes. And if you really like it, you can upgrade to a year and get a much better deal. You can lock in a lower rate and get great value out of it. I've often told people, if you can make one or two better decisions in a month, I feel like that should more than pay for your membership, hopefully. Three main benefits. Number one, access to our custom or members-only reports, our weekly flight plan, and our monthly chart review. We just actually put out our March monthly chart review earlier this week. You have access to all of our educational courses, flight school, we call it. We talk about behavioral investing, technical analysis tools, behavioral biases, technical indicators. You also have access to all of our previous webcasts where we dig in a lot more detail in some of those topics. And then you also have access to our members only community. It is a great supportive group of like-minded investors looking at charts, asking questions, helping each other out. I'm in there every morning answering questions from our premium members and dropping words of encouragement as we go. So again, you can learn more information at marketmisbehavior.com. Click on become a member in the upper right. Don't forget to use the code YouTube when you check out for a special deal on your first 12 months on any plan. Would love to see some of you join as a premium member for sure. We'll be very happy to answer your questions in our members only community. Next question. This came from someone who's actually studying for their CMT level 2 exam, I think you said in the question. So congrats on that. I learned a ton from going through the CMT process. That stands for Chartered Market Technician. That's the letters that I have after my name, and a lot of my guests that I've interviewed are CMT charter holders as well. It's a professional designation for technical analysis. It is a very structured, a process of learning the technical toolkit and being, and basically demonstrating how to apply it in an investment setting. So congrats on your progress so far, and I wish you well on the level 2 exam. That's where it actually gets pretty challenging. Level 3 is the toughest one, but good luck. Your question, could you discuss the Williams percent R indicator versus RSI, and why would you use one versus the other? Really thoughtful question. And I will tell you, if you want to learn technical indicators, because you're at the point in your career, it sounds like where you're learning, and we're all learning at all points, I should make it clear. But one of the things I was going to say asked to do, but I was really instructed, I was told to do it, was to prove out every technical indicator that I could find in Excel and literally get the price data and then calculate the indicator. I learned a ton. I mean, I hated doing it and it was not my favorite use of my time. But now looking back, I know a lot of these indicators so well because of being forced to learn them. And you quickly learned which indicators were similar to one another. You would see how this indicator you're doing now is just like an indicator 3 indicators ago, and you look at that sheet and you'd be like, oh, I see the differences that they're doing. Because at the end of the day, a lot of technical indicators are very similar, right? There's only so many building blocks that we have. It's price or volume data, usually. It's using moving averages, exponential averages, closing prices, high and low prices, true closes, average prices. Again, there's only so many levers, and then just, the number of days, the way you smooth it. And so a lot of indicators end up being very, very similar with just subtle differences. And the two you mentioned actually are a little more different probably, but Williams percent R is almost identical to an indicator called stochastics. Let me butcher this chart of Amgen. You asked about RSI. You asked about Williams percent R, and I'm going to drop an indicator called fast stochastics so you can see how similar these are. All right. So these are the 3 indicators, and I'll zoom in a little bit just so we can see it in a little more detail. So RSI is this first panel below, 14-day RSI. Below that is the 14-day Williams percent R. We'll start there because that was your question. So the main difference here is that RSI, the logic behind it, or the math behind it, is you're looking at a period of time and you say, what's the average up close versus the average down close? When we close up on the day, how much higher do we tend to go? When we close down on the day, how much lower do we tend to go? So the RSI is essentially the average up day versus the average down day over a look back period. It also uses an exponential average in there just to smooth it out and be a little more sensitive to the more recent data. But at the end, that's the basic logic of the indicator. It's my preferred measure of momentum. I look at it on almost every chart I bring up, as you probably know from watching my content. Williams percent R does a different comparison where it actually looks at where we close on a given day versus the high and the low. And it actually does a look back period, a 14-day look back period. So where are we right now versus the highest high and lowest low over the last 14 days. And the way that it's designed, going from 0 to negative 100, is it basically shows you at any point how far are we below the highest high for the last 14 days. That's kind of how I would think about it. So if it's at 0, that means we're literally at the highest point we've been for the last 14 days. If we're at negative 100, that means we're 100% of the way below. We're at the lowest low for the last 14 days. So there will be some similarities, right? So you can see generally when the RSI is strong, the Williams percent R is strong, and the opposite. But you can see the dynamics are very, very different just because of that particular way that it's calculated. And the exponential smoothing in RSI makes it a little smoother in general. Now, if you compare the Williams percent R to this black line called fast stochastics, you will see that they are literally identical. The numerical values are going to be different because stochastics, which is an indicator created and popularized by George Lane, basically quotes it as how far you are above the lowest low over a look-back period. But it's doing the same thing. They're both looking at the last 14 days in this example. They're looking at the overall range and seeing where we're at. It's just the way that the numbers come out are different. But at the end, they are literally the identical calculation. Just the math comes out a little bit. The numbers come out a little bit different. So Williams percent R is basically the stochastics indicator, just with different labeling and all of that. I would say, using Williams percent R and using stochastics is a real waste of your time. Using RSI and one of these indicators, maybe, but I would encourage you to find one of these that you find matches well with your time frame and with your investment horizon, and whichever one provides the signals that help you make sense of the chart you're analyzing, I would pick that one and just stick with it. That is what I did years ago, where I found RSI was really helpful. I loved particularly the divergences and the range rules that I found really, really helpful when I read Connie Brown's book years ago. And so that's the one that I use. Those are your differences. And again, I challenge you, go through RSI, Williams percent R, and stochastics, create those three in Excel, and you will see what I just described, but you'll have all the math behind it and may help you prepare for the CMT level 2. I'm not sure. But thanks for the question and good luck on the exams. Next question. You pointed out the 4 sectors outperforming the S&P. We talked about that earlier this week. I forget if that was yesterday or Wednesday's episode, and suggested that would be a good place to find stocks to outperform. How would you recommend finding those candidates? Yeah, I remember your question. You asked about, would you use scans? Would you just look for different charts? Like, what would you do? So once you've identified some sectors that are showing strength, and we talk about things like consumer staples and healthcare and things that have been doing well on a relative basis, the sectors with a strong relative performance year to date. What do you do there? So 3 things I would think about, and this is what I tend to do. Number one, I usually look at the S&P 500 and maybe even the S&P 400 members in those sectors. Couple ways you can do that. I actually have a chart list tied to the S&P 500. And I usually order it by sector and group. So I do this, and then and again, this is not a stock charts masterclass, so I'm just going to blow through this really quick. But basically, I'm ordering this list of the S&P 500 names by sector and subgroup. And then I'll go up here and, start to look. So it's grouped by communication services and then by discretionary. So what I usually do is start looking up here and then go to, let's talk about like healthcare. So healthcare is going to be after financials. Here we go. S&P Global AbbVie. And I look at this list pretty often, so I kind of know where things are at. I just start going through the charts in the S&P. I would do the same thing with the S&P 400 mid cap index and just look at the members in those indexes. That's 900 stocks. And it's going to be the key names that the good news about stocks being in one of those indexes is the folks at S&P sort of do some basic due diligence to make sure they're liquid enough and that their volume is decent enough. And these are well-known names that have plenty of volume. So you're not going to scan and find some random thing that you don't know. These are companies you probably know, particularly the S&P name. So start there and look for stocks showing the characteristics that you think are strong. For me, strong relative strength is what's most important. Strong technical, actionable, movements in price. Second thing would be use the scanning engine, right? So, do the scanning engine. And again, I use stock charts pretty often, but I actually have scans already built to look at the members in different sectors. And then I can add different criteria in there. Things I would look for, things pulling back to an ascending 50-day moving average, things making new 3-month highs. Those are things that I tend to start with just to see what kind of names come out of those lists. MACD buy signals, weekly MACD buy signals can be good too, finding things that are starting to rotate higher. And then the third thing would be the scooter rankings, right? So looking at the stock charts technical ranking or some sort of quantitative model that's based on price momentum that will show you the strongest chart. So I have a scan that I use on stock charts and it says members of this particular sector, and I'll change it when I need or a particular group. And then a scooter ranking above 80, which means it's in the top 20% of stocks within its cap tier. Those are 3 things that come to mind, looking at the S&P large cap and mid cap names in the sector, running scans based on some of those metrics that I mentioned, doing the scooter rankings, looking for stocks that score pretty well based on the stock charts technical ranking. So probably get you some interesting charts to look through. Next question in the Christina Hooper interview. Yeah, and thanks so much. I want to highlight this one. I appreciate you watching the Market Misbehavior podcast. Really, we launched in last fall. I think we just released our 32nd or 33rd episode. And Christina Hooper, we released earlier this week. It was a really awesome interview. Christina is the Chief Global Strategist at Invesco. I also just released an episode earlier today with Keith Fitzgerald, which was awesome, about mindset, about proactive investing, which I thought was really interesting. And then Jordan Kimmel, actually releasing an episode with him tomorrow. He's written a number of books called The Magnet Method of Investing and some others. But his Magnet Method, he's a quantitative investor, and really interesting comments about how to look for companies showing strong characteristics. So thanks for watching the podcast. I would encourage you, the rest of you, to check it out on our YouTube channel if you want to check out some good conversations with smart people about the markets. So in my interview with Christina, I remember you discussed an individual policy statement, which made me think of Peter Lynch's 3-minute rule in beating the street. What goes into an individual policy statement? Thanks for mentioning Peter Lynch's. I think what you're talking about, we actually, he had a 2-minute drill, which is what it was called. And the 2-minute drill, he wrote about it in at least one of his books. I remember that. And when I was there at Fidelity from 2008 to 2016, still, I think once a month we did that, once a quarter. I forget how often. Now back in the day, and Peter's kind of heyday in like the the 80s, they could fit all the portfolio managers around a big conference room table. So the idea was all the portfolio managers came in, all the analysts came in, and they would literally, each analyst would have 2 minutes to pitch an idea. When I was there, we had quite a few portfolio managers and quite a few analysts because the firm had grown quite a bit since Peter's heyday running Magellan. And so, we couldn't fit everyone, but we would have a packed room going through the 2-minute drill. And the point of that was you have only 2 minutes to hit to explain your thesis. Financial analysts generally tend to be pretty wordy and just, exhaustively go through models, and they spend all these hours and hours getting to know these companies and how to value their stocks. And Peter would tell him, you got 2 minutes. And then literally we would have a stopwatch, and someone would have the stopwatch, and it'd be like, click, and you'd have 2 minutes to pitch it. And it was just so fascinating to, just people would have to rehearse and get ready to just summarize it. But it really forced you to understand the point, right? Forget about all the noise, forget about all the stuff. Like, what's the point here? And really get to the most important things. It was really, really fun to do that meeting. And I enjoyed being a part of those as often as I could. So Christina and I talked about what's called an individual policy statement. And basically what that is is what I explained and what Chris and I talked about is new fund managers in an institutional setting will often have to write their policy statement, right? Sort of like, what is a one pager of like, what are you trying to do? And the general parts of that would be, what are you going to do? How are you going to do it? And how are you going to manage risk, right? So what are your goals? How are you going to get those returns? Like what are you trying to do? How are you going to generate the returns to accomplish those goals? And how are you going to manage the risk that is inherent in trying to get those returns, right? And those are kind of the three general things you'd want to hit on. And I think for an individual policy statement, really going through the exercise of getting one page and explaining that. So that's how I think of it. So number one, what are you going to do? Right? What are you hoping to do? What is your investment thesis? What's your goal? What's your edge? What's the structure? Right? How are you going to put together a group of things that make that grow in value? And so just really think about what the goal is, what your purpose is, what your investment horizon is, and just how you're going to actually what that structure is going to look like. Then the second one is how you're going to generate those returns. So it's things like idea generation. How are you going to find new ideas? What are you going to read? Who are you going to listen to? What information are you going to consume so that you can identify what platforms you're using, what systems you're using, what resources are you going to leverage to help you accomplish that investment goal, and really think about the practice of how you're selecting things. So we would talk about allocation, security selection, right? What percent would be in different things ideally, how we're going to find those ideas and how we're going to rotate them. And then the final one would be risk management, right? And the way I think of this is how would you know you're wrong, right? What are you going to do to make sure that you don't hold on to things way too long? How are you going to make sure that when things are no longer fitting your mandate, you get them out of there? What's your stop or exit strategy, your trailing stops that you're going to use? So again, just think of it, but the point is to put it on one page, right? The point of the 2-minute drill is you have to be concise. So you got one page in a Word document or a Google Doc to make those 3 points. And if you're going over one page, tighten it up. And what that forces an institutional investor to do, and I hope it would encourage you to do, is just be clear on what are you actually doing. It really helps you define your goals, because a lot of times what happens is individuals are not really clear on what they're trying to do. They're just trying to buy stocks that they think are going to go up, I guess, right? But a savvy, a mindful investor has a purpose, right? What are you doing this for? And what's your sort of thesis there? We don't think about how we're going to find ideas, so we end up just doing it kind of haphazardly or sporadically. Someone mentions a ticker and you look it up and then you buy it. I mean, that could work, and I hope it does, but I mean, that's not a great systematic, disciplined process of finding ideas. So we want to get away from that. And then I think mindless investors just don't manage risk, because it's not fun to think about how wrong you're going to be. You're going to be wrong a lot, and you probably know that from if you've been investing for a while. So I think thinking of that third piece is pretty good. And as I'm answering this question, I feel like there's a webcast in there. Maybe that's a course for my premium members. I'm going to dig into that one a little more, because I really like where I was going with some of those thoughts. And I appreciate you asking that thoughtful question about my discussion with Christina Hooper about policy statements and alluding to Peter's 2-minute drill, which is a lot of fun. Folks, that was it. I hope you enjoyed this one. I really enjoyed some of these questions. I appreciate you allowing me in today's episode to go all around the world. We went to some global stocks. We talked about price patterns. We talked about the CMT, calculating indicators, scanning for ideas, policy statements. That's a week. I think we did it. Thanks so much for joining me here today. Thanks again for all the thoughtful questions. We'll be back on Monday. Fingers crossed we safely travel back to Seattle on Sunday. Hope to be back and better than ever with the show on Monday. In the meantime, check out our recent podcast interviews. And again, most recently, Keith Fitzgerald out to today, maybe yesterday. And then tomorrow, one more episode from the Las Vegas Money Show, that one with Jordan Kimmel. And have a great weekend. And remember, it's always a good time to own good charts. Take care, folks.